Good afternoon, everyone. Welcome to this month's free WCMA member webinar. I'm Grace Atherton, WCMA's Communications Director, and I'm so glad to have you with us today as we take a look at what may be in store for milk prices and dairy markets in the year ahead. First, I want to just give a couple of housekeeping notes very quickly. Please make sure your mic is muted and your video feed is off so we can avoid some interruptions during our webinar. You can also submit questions anytime in the chat during our session, and we'll do our best to get to all of those during our Q&A portion at the end of today's webinar. A recording of this webinar, along with a list of resources and helpful contact information, will be shared later this week, so please watch for that from me in your email inbox tomorrow. And with that, we will take a quick look at our agenda before we get going here. First, before we dive into next year, we're going to hear from John Umhoefer. He's WCMA's Executive Director, with a look at new regulated prices following years of industry advocacy to update the outdated pricing formulas in federal milk marketing orders. Then we'll get to our featured guest speaker. We have Kathleen Noble-Wolfley of Ever.Ag joining us today for a broader forecast of what you can expect from dairy markets in 2026. After that, we'll move into our Q&A at the end of our webinar today, and we'll get you wrapped up and out of here at 2 o'clock Central. So without further ado, let's get things started. John, I will turn things over to you.
Okay. So I'm going to be brief. Kathleen's the star of this show, but I did want to take kind of the regulatory slant on milk prices. I think the bigger story now is components, but there was the big impact in the spring of this year when we did have the prices come to be, the new federal order milk pricing decisions, and the big change there being the make allowances that took effect in June. So as you know, probably the big story for most people listening is the cheese and butter make allowances. Of course, the dry whey is important too, but we did see a rise in make allowances. So on the next slide, what we've seen for the class 3, the cheese milk price is a weakening, but certainly not a fall off. And so I can't really attribute what's happened to that average $17.51 in the last 6 months to the make allowance change. I really think it's been rising milk production. It's been weakening butter values, and there's been some offset by the rising whey values. So it's really the components that have been the story more than the change in the make allowance. On the next slide, have talked to cheesemakers though, and the make allowance did make a difference. For example, they are seeing that their milk cost is more accurately aligned with their cheddar production cost. And it has allowed cheesemakers to reduce the downward pressure they had to put on components in previous years, or the pressure they had to put on raising hauling charges to try to make up for that trailing make allowance, that old make allowance. So there has been some positives, but really overshadowing that has been the soaring milk components, particularly butterfat, that has made a difference in the milk price, and I think is really coloring a lot of what Kathleen's going to tell you. But at the cheddar level, our members are reporting now that they're seeing, and maybe you're seeing, 4.2% butterfat overall on farms. Protein is up 1 or 2 tenths of a percent. And so when we look at something like a class 3 price in November of 1718, what's important for everyone to understand and for us to translate it to cheesemakers, to people who think that's the price farms are getting, these farms are getting as much as $1.50 more for butterfat at their test, or perhaps 50 cents more on their protein. So a combined $2 more than that $17.18. They're getting a better milk price because they're really loading up on the components. And I think my final slide really translates this issue for our smaller manufacturers. And this is something we did this fall, asking Center for Dairy Research and Mike Brown from TC Jacoby to explore the impact of this excess butterfat we're seeing and the rising protein values on a smaller manufacturer, and see what we can do to help our manufacturers try to rise up that value chain. You know, the value of that butterfat can be better outside of the cheese vat. And so can we look at separators for all manufacturers of cheese as we move forward? And what can we do to get people to help rise up the whey processing chain? Mike had this dramatic slide in front of you that showed that If you are at the bottom of the whey chain, for example, selling wet whey for 5 cents a pound of solids, you are losing up to in the last 5 years, 30 cents per pound of cheese for that portion of your intake. So you are basically cutting into your profitability because your whey is a net negative return. So how can we help members rise up the value chain into cool and then concentrated and then ultra concentrated ways so that those go from a negative to a net positive for our manufacturers? And I want you to know too that when we offer up resources to you after this talk, we could and will offer Mike's entire presentation filled with his numbers on how whey values are working out for cheesemakers. So that was just a little snapshot on the regulatory side, but the real star here, I think, is Kathleen looking at the macro global picture of components. So I'm going to turn it over.
Thanks so much, John. I appreciate it. Give me just a moment. I'll get my screen shared here. All right. Well, hopefully you all can see that. I am really excited to be here with you today. I think we have a lot of great stuff to talk about, starting with going off of John's commentary on the whey market. Let's talk about protein. I think that protein is probably going to be 2025's word of the year. I'm sure that Webster has already come out with their word of the year, but for the dairy industry, I think it's protein. It's everywhere. Everyone's talking about it. I think CBS Sunday Morning even had a bit on protein in the last couple of weeks. There are protein claims that are lining the grocery store shelves. They're making their way into food service operations. It's on trend, it's gathering steam. And from where I sit, I think it's really good news for the dairy industry. Why protein? Well, I think as Americans, at least if some Americans are on a wellness kick. We're seeing fitness center foot traffic, healthy, up on a year-over-year basis. People are going to the gym. Demand for things like ready-to-mix beverages or ready-to-drink type beverages, those types of products continue to grow. The data that we see from Circana suggests that the sports nutrition category is seeing continued strong growth. RTD volumes up by about 15% year over year. Sports powders up about 13% year over year, and that's on top of already a strong base. So we continue to see significant growth in the protein category. In my estimation, GLP-1s are a big piece of this protein puzzle and likely having at least an impact on the protein side of things, as well as potentially explain some of the demand lethargy across the rest of the dairy complex. Recent data from Gallup suggests that in Q2 and Q3 of 2025, about 12% of US adults were using a GLP-1 medication. That's up from about 6% of adults in Q1 of 2024. That's a lot of people that are focused on taking injections for weight loss or generally just focused on weight loss. And when we look at studies around what does it mean? What does the GLP-1 usage mean from a calorie intake? Studies show that it does reduce overall calorie intake by 20 to 30%. Every day. So as we think about how people are shifting consumption, how it impacts the protein side of the equation, how it impacts overall dairy demand and just demand for food in general, I think there's a lot to this GLP-1 story, and it will continue to be a big story as we go into 2026. So what's the impact on dairy from where we sit today? Folks are certainly changing how they're eating. Recent studies suggest that spending at retail 6 months after adoption of a GLP-1, people were buying fewer chips, fewer savory snacks, fewer cookies, less cheese, less butter, less ice cream. That ultimately does have an impact on the dairy that's going through a retail channel. You may think about chips or savory snacks and say, well, there's maybe not a lot of dairy in there, but think about Doritos or Goldfish. Those all have cheese in them. Same thing with cookies. There's a lot of non-fat dry milk or dry whey that's going into those types of items. Cheese, that's a pretty obvious one. But on the flip side, as we look at the protein space, and part of the reason why I started this presentation with protein is hot is these GLP-1 users are focused on increasing how much the protein they're consuming, how much fiber they're consuming, and really limiting the fat and the sugar. So I think that there is this push and pull from a dairy perspective as we think about GLP-1s and the impact on consumption of there are winners and there are losers. Protein seems to be a winner. Yogurt seems to be a winner. Cottage cheese, a winner, all because of that high protein claim. But on the flip side, things like ice cream, butter, cheese may not be making out quite as well. So as we bring it into the protein space in general, demand for high protein it's popping. Demand is really strong. As I mentioned, those RTD beverages, the sports powders, those are all seeing really strong demand. That's led to super tight stocks overall here in the US market and across the globe, in part because even though capacity is expanding, demand is well outstripping the capacity that's available in the marketplace. And some sources would even say that demand is outstripping and will continue to outstrip what available capacity could come onto the marketplace in the coming years. I think that there's some limitation in how much folks can grow their new offerings because of the limitation of available supply and cost too. As we see that roll into the dry whey marketplace, ultimately, I think it's the tide is lifting all boats here. We have the dry whey market that, for the most part, on demand hasn't been all that exciting. I think things are holding steady, but we're not shouting from the rooftops about how great dry whey demand is. But from a supplies perspective, whey solids that are available are going up the value chain to supply the high protein market. I think that's leading to some tighter supply on the dry whey side. So even though demand isn't all that stellar, we continue to see support in that dry whey market on the back of limited supply availability. So as we look at the protein space, as we look at just where that market is going, I think that there are some favorable trends, some bullish trends on the high pro space going into 2026. So that is the good news from a dairy perspective, or the bullish news from a dairy perspective. And there's part of the reason why I started today on a peppy tone, because unfortunately I do have quite a bit of bearish news to deliver here this afternoon. No surprises here. We've got cheese and butter prices that are sitting at the lowest level in quite some time. And I think as we look at pressure across the marketplace, it is continuing to mount. We're looking at cheese prices that are below $1.35 per pound this week. That's on CME blocks. First time since 2023 that we've seen those low prices. Butter seems to be treading water in the mid 140s, kind of bouncing in that 140 to 150-ish range for the last few weeks. So ultimately, as we look toward the end of the year and on into early 2026, the read on these markets in particular is fairly bearish. And in my estimation, milk supply is one of the big drivers of some of this weakness. We've got milk, and more milk across the US and more across the rest of the world. It's the theme going into the tail end of this year, and it will continue to be the theme going into 26. U.S. milk production in October increased by 3.7% year over year. We've got cow power, even though cow numbers declined by 6,000 head from September to October, we're still up 200,000 cows year over year. That's a pretty massive jump in the available cows that are getting milked every day. In our estimation, it's hard to imagine a marketplace where we see notable contraction anytime soon, and certainly a notable pullback in cow numbers anytime soon, particularly on the back of weaker production in California last year. We suspect that the next couple months we could have some pretty notable increases in U.S. milk production year over year. And the other thing to keep in mind is that it's not just the milk that we're seeing growth. As John talked about, we're seeing more pounds of fat in every load of milk that's getting delivered to a cheese plant. U.S. average fat tests in August were running at 4.16%, up from 4.1% the year before. I suspect once we'll see the September and October data here, I think that's coming out from USDA on Monday, we'll continue to see an increasing trend in overall fat tests at the farm level. So if you combine, looking back at August, if you combine 4.16% fat tests with an increase in milk production of about 3%, we've increased fat supply just off the farm by about 4%, 5% year over year. That's almost 40 million pounds of additional fat year over year, just in terms of gains in average fat tests. So as we think about the butter market going forward and fat availability off the farm, I continue to expect that at least for the intermediate term, we will continue to see lots and lots of fat available at the farm level. And keep in mind that the increase in fat tests at the farm level is not just due to what we're feeding and how we're feeding it or animal husbandry. A lot of this has to do with the genetic progress that we've seen in the dairy herd. And to some extent, I think we've been in a position where we've been leapfrogging genetic progress on dairies for the last couple of years. There's still a relatively small percentage of dairies that are genomic testing. So essentially, figuring out from an early age what kind of genetic capacity, capability a dairy cow has to make milk, make fat, make protein. We've been able to test that and breed for it and make selections on what kind of semen a dairy is going to use to breed that animal to in the herd for their herd going forward. So if you have an animal that's a high genetic capacity, you're going to breed that animal to a really fine dairy stud. If you have a genetic animal or an animal that's not all that genetic, or doesn't have great genetic progress, you might say, hey, I'm going to breed that animal to beef. So ultimately, the best are getting better, and we're breeding the bottom end to the beef herd. And that has ramifications as we think about cow numbers going forward. So that's the milk production story, at least as it sits today. But I think it's important to keep in mind that milk margins are starting to slide. We're seeing futures prices lower for both class 3 and class 4 prices, certainly seeing declines in the spot markets here over the course of the last couple of days has led to, at least on a synthetic basis, weaker class 3 and class 4 synthetic values. Margins at the farm level are starting to weaken with the DMC, the Dairy Margin Coverage Program, estimates based on futures falling in that $8 to $9 per hundredweight range. Ordinarily, we would suggest that a slip below the $8 per hundredweight DMC margin is cause for concern about milk production expectations going forward. But I think there are a couple things we need to keep in mind as we go into 2026 that may potentially kick the can even further down the road on potential pullback in milk supply growth. And one of those things is beef income. So I talked a little bit about the ability to select for, hey, what animals am I going to keep in my dairy herd to try to increase my genetic progress, or what animals am I going to breed to beef? And we see an increased focus on dairies breeding additional cows, dairy cows, to beef semen. And it's no surprise that they've gone that route, because with the cattle market so strong relative to history, near record high levels on cattle prices, and beef on dairy calves continuing to see very strong returns in the $1,000 to $1,500 per day-old calf, that's bringing in a tremendous amount of revenue for dairies. Our math puts it at somewhere between the dairy calves or the beef on dairy calves as well as the cull cows. We think that there's probably about $3 to $4 a hundredweight of just beef income that's coming to the dairies on the back of these higher cattle values. That ultimately, in my mind, suggests that, hey, profitability at the dairy level may be okay as we go into 2026. Certainly on a milk margin perspective, things are looking a little bit tighter, and history might suggest we should see a tightening of the belt, but add beef income on top of it, and the picture may not look so terrible. But I should note that cattle is starting to feel some pressure. The live cattle prices, the feeder cattle prices have come down quite a bit over the course of last month. We found a little bit of traction here in early December, but in general, things are off the highs. Beef on dairy cross calf prices have come down a little bit as well, at least on a cash basis. So I think there's a lot of questions as we go forward about, hey, what kind of decisions do dairymen make around breeding to beef, and how many extra animals will they hold on to because of this opportunity? I think some of the growth that we've seen in cow numbers here in 2025 is because people held on to more animals to try to maximize their beef on dairy their beef on dairy revenues and overall income. But now that we're seeing tighter milk prices, will dairies start to say, hey, you know what? I think I'm going to cull a couple extra because I don't necessarily want to feed all these extra cows if my milk income isn't all that great. Or do we see dairies make the opposite choice and say, hey, I'm going to hold on to these cows that have a beef calf in them because there's a notable revenue boost on the back end once this animal calves, and I'll make a decision about what I do with that cow after she calves. I think it's important to remember that this amount of revenue from a beef on dairy cross calf for a day-old calf is pretty much unheard of. These are record high levels. If I would have told a dairyman 2 or 3 years ago, hey, you're going to be getting $1,500 for a day-old calf, they would have laughed me out of the room. 2 or 3 years ago, we were talking about $200 to $400 per day-old calf. There's a notable amount of revenue here on the table. And I think that's leading to a lot of questions in our own milk outlook. The other thing that I think could potentially kick the can down the road around our milk production expectations and the possibility of things starting to tighten up a little bit because of lower milk prices is risk management. We have a notable amount of milk that is covered through the Dairy Revenue Protection Insurance Program. We have dairy margin coverage program tools out there in the toolbox for dairies to use as well. So there is potential that dairies may not really feel the full effect of weaker milk prices if you consider the risk management tools that they've had access to and appear to be utilizing, as well as the beef income that's maybe helping to true up some of the weaker milk price expectations. So that leads us to this question of, okay, when will milk production start to retreat? And I'll go back to it again. It always takes longer than we think. And ultimately, I suspect we're kicking the can down the road. The 6-month forward-looking milk margins clearly are sinking today. And history suggests that it may still be a few months before, a few months being maybe 6+ months before we really see any sort of notable pullback. And again, I think between risk management and strong cattle income, it may be even longer than that 6-month period that history would seem to suggest. When we look at potential different culling outcomes, so say the beef cattle market turns into a bit of a dog, we see prices moving swiftly lower, and producers say, hey, I'm going to get out of some of these heavy cattle inventories before I lose my shirt on all these additional cows that I'm holding on to, and I'm going to start to liquidate my herd pretty quickly. If we see that big turnaround in how quickly cows get culled, we think that it could be Q3 by the time we see a pullback in U.S. milk production. But let's say cattle prices stay relatively high relative to history. It may not be until Q4 that maybe we start to see a little bit of a slowing of the growth in U.S. milk production. We'll probably end up somewhere in the middle with a medium liquidation situation, but certainly it makes you think about, okay, we're in this position with tighter milk margins, but really it's going to take a while before we see any sort of notable pullback in milk supply in the U.S. And I think it's important too to call out that it's not just the US that has a lot of additional milk on the marketplace. Europe and New Zealand are both seeing significant growth on a year-over-year basis as we head toward the tail end of 2025. Europe, to me, it is the big call out. Milk production in September increased by 4% year over year. October was up 5% year over year. And sure, Europe goes in these cycles of they'll see some growth, we'll see some pullback. Last year was a year of pullback, so we are looking at some pretty weak year-over-year comparisons. But I think that the important thing to note here from a European supply perspective is that this growth was a surprise. As we talked to analysts across the industry going into 2025, the expectation was, hey, we're going to see maybe flat milk production growth, maybe a little bit of a gain on a year-over-year basis. So to come into the third quarter with plus 4% growth, plus 5% growth, and I don't know as though the gains have started to slow notably here in the last couple of weeks, but I think that we're in this position where Europe is suddenly sitting on more milk than they expected. Processing plants are running more milk than they anticipated. That's more cheese, that's more butter, that's more powder that's coming out of Europe. And at the same time, our exports have been pretty strong. We've kind of been eating Europe's lunch on the export front here in 2025. So there's sales that they hadn't planned on, more product that they're producing, and more milk coming behind it. So I think Europe is in a position where we've seen significant pullback in their commodity values on the back of this increase in supply. And ultimately, I think the combination of more milk in Europe, more milk in New Zealand, more milk in the US is leading to a significant pressure on global commodity values as a whole. There's just a lot of milk, there's a lot of product out there. I think that the European situation may not be, their growth may not be as long standing as the US is. Sure, beef values in Europe are high, but I don't think they've leaned into the beef on dairy markets quite as much as we've seen here in the US. And I suspect that we'll see a pretty swift pullback in European milk prices here in the coming months, which may lead to a trim in milk supply, or at least a slowing of growth as we get into late Q1 and on into Q2. But still, I think that we could have another couple of months of lots and lots of milk across the global marketplace. That leads us into a discussion around exports. 2025, we've crushed it here in the US. The September trade data landed here just this morning. We saw record high exports of cheese in August. We saw, I'm looking at my slide and seeing that I have a typo here. There was 117 million pounds shipped in September, which was up 35%, a little off that record from August. Still, we've exported year to date 999 million pounds of cheese, up 17% year over year. And like I mentioned, some of that's coming on the back of eating Europe's lunch in the global cheese market. We've won a lot of opportunities into what I'll call contestable regions across the globe. Think South Korea, think Japan, Southeast Asia to some extent. Central America has been a big winner for us as well. So I think that as we looked at 2025 exports, we hit the ball out of the park. The big question now is, can we keep that ball rolling in 2026, similar to what we had in 2025? And my concern is that as we go into next year, it may not be lining up to be quite as successful, at least early on. And part of that's driven by this increased competition in the cheese market. As we headed into 2025, our prices were cheap relative to Europe's. We generally look at the CME block market versus the EEX mozzarella price as kind of a proxy of our competitiveness. And during this time frame of late 2024, we were pretty cheap relative to Europe. And it stayed like that for the better part of 2025. And clearly, we won. We suspect we probably need about a 20 to 30 cent discount to the EX mozzarella price to win. We clearly had it on a spot and futures basis, and we've seen those opportunities take place here in 25. But as we go into into next year, our prices have been uncompetitive versus the European values. Over the last couple of weeks, we've seen CME block prices and futures well above the EEX mozzarella values. And anecdotally, we've picked up some commentary that maybe Q1, potentially into Q2 bookings haven't been all that exciting. I suspect that this recent fall on CME block prices into the 135 range may help to stir up a few more phone calls toward the end of the year. But I don't know that it'll be enough to really change the trajectory on Q1. Maybe it'll open up some opportunities for Q2 and beyond. But again, I think that if the U.S. needs to be in a position to move more exports into the international market to keep our market from being overloaded by supply, export competitiveness will be one of those key things to keep our marketplace from being overwhelmed by supply. And again, I think we probably need to be in that 20 to 30 cent below the European market to really win. And part of the reason why we're so focused on exports is because our domestic demand hasn't been all that stellar. As we look at restaurant performance for most of 2025, it's been pretty lethargic. Traffic has been a little bit better here in October and November, but some of our key places where we eat a lot of cheese, into pizza restaurants, not performing all that well on a year-over-year basis. So as we look at the food service marketplace as an avenue for growth in things like cheese demand, and restaurant traffic remains pretty slow. I think that there is risk that as we go into 2026, that domestic demand could stay pretty lethargic unless we see a big shift here. I think ultimately consumers have grown tired of menu price inflation. It's really expensive to take the family out to dinner. And we've been dealing with this persistent menu inflation for the better part of a few years now. I did want to call out really quickly, though, that we are starting to see some strange traffic patterns in the data that we look at. At grocery, for the last few weeks, we've seen better than prior weeks foot traffic. We've seen some better throughput at restaurants and QSR as well. We wonder if there's maybe a bit of a SNAP element in here, or at least the noise in here, in that, hey, folks maybe didn't have SNAP money to spend in grocery, so perhaps they went into a restaurant and QSR instead. It's a little counterintuitive, but maybe it was a way to cut down on grocery spending and wait it out during the shutdown. At the same time, maybe if people didn't have as much money to spend, they were making fewer trips to the grocery store with lighter grocery tabs. In general, we really don't see any obvious improvements in the macro environment that would suggest a wholesale change in overall consumer demand. I will say from a holiday perspective, even though there was kind of lackluster promotion in the retail sector on cheese, we did see okay sales through mid-November, up around 2% year over year for much of the month of November. Cheese prices did come down a little bit. We did see some bits of and flashes of promotional activity going into Thanksgiving, but I'll be curious to see how the Christmas and New Year's season and into Super Bowl pans out. One thing that I'm keeping in mind is per capita cheese demand. And this goes back in part to the GLP-1 discussion that I started our conversation out with today. What's interesting to me is that as Americans, it does appear as though we're eating less cheese. I don't have a great sense of why we're eating less cheese. Is it because people are taking GLP-1s and they're focused more on high protein beverages or yogurt or cottage cheese versus a cheddar or a Colby Jack? And they're trying to reduce overall caloric consumption. But overall, I think this is something to keep in mind as we go into the years ahead. Are we continuing to see a pullback in overall per capita consumption? Because it is certainly a concerning trend as we think about growing U.S. cheese demand in an environment with new capacity that's come online And I think just overall reminds us that export competitiveness is extremely important going into 26. Shifting gears to talk a bit about the butter market. Butter exports have been gaining momentum here in the last several months. We saw 18 million pounds shipped in August. We saw 15 million pounds shipped in September, up on a year-over-year basis. So we are moving additional butter into the international market. Part of the reason why we're able to get that momentum moving on butter exports is we're cheap relative to the rest of the world. Certainly, we've seen European prices come down and New Zealand prices come down, but for the better part of 2025, we've been around $1 or more cheaper versus those key competitors. The gap has narrowed here in the last several weeks, but ultimately, I think that the U.S. manufacturer and the U.S. exporters have been really pushing to try to build export relationships on the butter side. AMF as well. They've been trying to get plants sorted to make 82% unsalted, which is the international spec for butter. So I suspect as we go into 2026, we could see a pretty strong export movement of product out of the U.S. But I think there's a lot of questions around what happens into later 2026, especially if those European prices continue to move lower. From a butter sales perspective at retail, I would say this is a pretty good news story. Butter and butter blend prices at retail have come down significantly from where they've been trending for much of 2025. Promotional activity was very strong going into the Thanksgiving holiday. I certainly saw some sales in my local grocery store that encouraged me to pick up a little bit of extra butter. And as we look at sales week 46 through 48, we were up about 3% year over year. My only concern from a retail perspective is as we see this more aggressive promotional activity, is it possible we'll be in a position where we're going to buy tomorrow's demand today? Meaning if you have aggressive promotions on butter, do folks load the freezer here in December and maybe don't need to buy quite a bit of butter until we get to say February or March when you run through those freezer stores or people building their own cold storage at home. So that would be my only concern from a retail perspective. But overall, we've heard some pretty good commentary coming through the holiday season here on butter. So to shift gears a little bit to talk more about the U.S. consumer. One thing that I found really interesting in 2025 and really makes me scratch my head as we go into 2026 is, are we in a position here in going into next year that maybe we just have fewer mouths to feed? We've talked at length for the last couple of months about just lethargic demand here in the U.S. Certainly, we've looked at the traffic patterns here around people just not visiting restaurants. They're going to the gym. They're not necessarily visiting restaurants. Retail sales have been okay so far in 2025, despite the fact that you would expect that maybe people would be visiting the grocery store more if they're not going out to eat. But in general, I just come back to this idea of, hey, maybe we just are feeding fewer people here in the U.S. Certainly, we've taken a more aggressive approach on immigration with this new administration. There are fewer people coming into the U.S. There are more people going out of the U.S. And ultimately, I just wonder if this is a demand impact that maybe we're not spending a ton of time talking about or considering. Maybe as we get into 2026, the numbers will start to even out and we'll get back to more normal growth patterns. But I do wonder if this has colored some of the 2025 data. And in my mind, colors some of the early 2026 expectations around demand. The other thing I'll say too, to wrap up the consumer discussion is I think that the US consumer is in a position of uncertainty. And depending on where you look, some people feel okay about their finances, some people don't feel so great about their finances. And it's really divergent depending on which area of the economy you're looking at. And if you've read any articles from the Wall Street Journal to CNBC to everything in between, you've probably seen a K-shaped economy or bifurcated consumer. I think that those are kind of the key words in the economy right now. And when we look at the data, I think it really bears that out. As we look at Morning Consult's latest consumer health index, it came in at around 3.3, which was off of August highs, but still well above prior levels. But when you dig through the data around income levels and consumer health by income level, it paints a pretty different picture. I think that the high income consumers are feeling pretty good about how things are going. The stock market is up. I think the S&P 500 year to date through November was up double digits. So I think there is a sector of the economy that's feeling pretty good about things. And generally, I think that they've continued to be your key spenders helping to drive this economy. On the flip side, those low to middle income consumers are maybe not feeling quite as great about their financial position. These are folks that have continued to deal with persistent inflation. There's a jobs element in here as well, in that I think people are a little bit more uncertain and uneasy about what the jobs environment looks like going into the new year. So ultimately, I'm of the opinion that we're consumer spending is likely going to stay uneven and it will likely remain vulnerable. So where that likely bears out in the economy is, do we see continued pullback in food service demand, or at least fairly lethargic food service demand as people look to trim expenses where they can? But again, if we go back to the GLP-1 discussion from the beginning of the call, I mean, I think we're also in this head scratching curiosity of, there is one end of the economy that's struggling to get by. They're pulling back on restaurant meals. They're looking for value wherever they can, whether it's retail or food service. But you do have another end of the economy that's using high cost weight loss drugs at the same time that they're spending big on high protein products. So it certainly is this uneven economy depending on where you look. And that's true from a dairy consumer as well. Well, now we get into the fun stuff, talking about the price landscapes and our expectations for the year ahead. So as we look at the futures market for cheese, as of yesterday, we were sitting at first half futures in the 157 range, full year 2026 futures for cheese in around the 165. As I look at our forecast, I'm going to take the under versus futures as of where they were trading today. In my mind, the downside risks on cheese, milk fails to slow down globally. If we continue to have a lot of milk available in the marketplace, that will continue to put pressure on all regions to stay export competitive. If the U.S. fails to book exports, that's going to keep a lot more cheese here in the domestic market, and we're going to have to go buy those export opportunities. And the third thing on the downside risks is domestic demand weakness. If we continue to see weak demand, particularly into food service, that will keep that much more cheese that's looking for a home. But let's talk about upside risks. Export surprise to the upside. If we do end up exporting a bunch of cheese in the first half of the year, that could help to clean things up. There's always the opportunity that we could see plant closures in response to new capacity, and there's always the wild card of potential for USDA intervention. On the butter side, our forecast is more or less in line with where futures are trading in that 180-ish range for full year 2026. Downside risks here, more milk means, in rising fat tests, means we've got a lot of fat off the farm. And like I mentioned, from a retail perspective, do we start to stockpile a little bit of butter in our own personal freezers into 2026? And does that maybe trim some Q1 retail sales? But on the flip side, as I mentioned, we've got butter and AMF exports that have been strong. If we continue to see strong exports into 2026, that may trim the available domestic supply that we build early on in the year. And ultimately, thinking to March and the new crop transition, if we don't build a lot of domestic inventory, does that potentially limit our new crop availability that ultimately may influence things as we transition in March? On the whey and non-fat side of things, our forecast is more or less in line with futures on a full year basis. In the non-fat space, we still expect things to stay relatively soft as we go into mid 2026. Demand on the non-fat side hasn't been really all that great, but at the same time, I don't think supply has been all that stellar either. But as we look at the global marketplace, there's certainly a lot of competitiveness in the mix. Mexico hasn't been buying as much, at least through this last several months. So unless we see a notable shift in demand, I suspect we'll kind of stay in this 110 to 120-ish range for much of 2026. And on a dry whey side of things, like I mentioned before, I think we're in a position where whey solids will continue to move up the value chain, and that will keep the dry whey market supply relatively snug in 2026. That's it for the price rundown. If you're interested in consumer insights, our team puts out, from Phil Plord, the president of the Insights Division, he puts out the Monday morning demand notes straight to your inboxes. It's a lot of really cool stuff on what are we seeing in the economy. We talk a lot about GLP-1s because our team is fascinated by it. What are we seeing for retail sales, food service sales? If you're interested, take a snapshot of this QR code, and it should help you send an email directly to insights@Ever.Ag to sign up for Monday morning demand notes. Interesting stuff delivered every morning or every Monday morning. So yeah, let us know if you're interested. And with that, Grace, I am all done with my presentation. I welcome any questions that the folks have.
Wonderful. Thank you so much, Kathleen. So much great information and data in there. And it's every year, I just love hearing your take and your predictions on how all these numbers will translate into the year ahead. So now I want to give a quick reminder to everyone on the webinar today that we will be sharing out a follow-up email after this webinar concludes with a list of contacts, helpful resources. So if you didn't manage to take all your notes, you didn't get something down, don't worry. We'll have you covered after this. And I want to jump into our Q&A here. So we have a couple of questions that were submitted in advance that we'll go through. And then we will open up the floor for a couple minutes in case folks want to share any questions that may have come up during Kathleen's presentation or John's presentation. So we'll start first with our pre-submitted questions here. And I'll throw this one to Kathleen first. What are your predictions for beef cross-calf prices in 2026? You talked a little bit about, where we're at with those right now. Can you kind of touch on that again?
Yeah, I think that there are a lot of questions out there around what does the beef market look like into 2026. We've certainly seen futures come down for the feeder cattle side of things as well as live cattle, and we've seen a little bit of pullback in beef cross-calf prices. It wouldn't surprise me that if we do see futures continue to soften some on the beef side, if that we'll start to see those beef cross-calf prices pull back some in 2026. But I still think that compared to history, prices will remain notably elevated relative to what folks have seen in the past. I guess I don't have any strong predictions of are we going to $1,000 or $750. I don't have a good sense of that. I think some of that's going to ultimately depend on what happens in terms of inventory, what happens at the Mexican border with imports of cattle. What does the Trump administration do in terms of beef prices? They seem to have a keen interest in that marketplace. So I think there's a lot of questions, but ultimately, I don't see beef cross-calf prices going back to $200 a head anytime soon. I think things will stay elevated, but may pull back some off of the highs.
Okay. Our next question, I think, Kathleen, we'll start with you on this one, and then John, if you have anything to add, feel free to jump in. How do you think the movement to define and regulate ultra-processed foods might affect demand, and by extension pricing in 2020, that should say 2026? We're not going that far ahead.
Talk about 2027 if you want to, but I don't know just yet. I think that as I look at ultra processed foods, and we'll talk about Maha in general. I think that there is a push from the consumer for increasingly less processed product. And I think in my eyes, the dairy industry fits well into those categories because we do have goods that tend to be less processed. Butter is just churned fat and a little salt, right? We don't have a tremendous amount of products that have a labeling, we'll call it labeling issues from a Maha perspective. So I think that there are opportunities from a dairy perspective that folks may lean more into butter. They may lean in more into cheese versus other goods. But on the flip side, I think there is this big question around the protein space. Because if you look at the back of a protein bar or a protein shake, there's a lot of things on the back of that label that may be considered more ultra processed. But I think that there is still a health halo around protein that may limit how concerned people are around those types of products. Like, does the good outweigh the processing? So that's just a real high level take, but John, I'd be curious in your thoughts there.
Yeah, our association and its policy committee took up this question because, as you know, the government asked this fall for comments on whether people wanted to see a definition for ultra processed foods and what shape that would take. And what came out of our committee and with the writing of Rebecca Sweeney on our staff was basically a no. We don't want to see a definition for ultra processed foods. We think for three reasons. One is the US already has an effective set of standards and guidelines through FDA and USDA, from nutrition facts to ingredient panel statements to health claims. We've got all the ingredients a consumer needs right on that food product to make a decision about health. We, unlike other countries, I think we're miles ahead on that. Second point that we made was that dairy is this concentrated, natural food source full of nutrition that's crucial for people. Milk, one ingredient in the jug, 4 ingredients on a cheese label. It's the original clean label food. Finally, food processing doesn't necessarily deserve a bad name. When you look at pasteurization, one of the great advances of our civilization in the last 100 years, it's a safety positive. It's not a negative necessarily to process foods, especially a food with a few ingredients that's ready to eat right from the jug or from the block. So we look at that as something that's just not needed. Dairy certainly doesn't fit in the definition. When you look at the delivery, the outcome that you get, the great nutrition you get, you don't deserve to be lumped in with what people might consider ultra processed foods.
All right, great perspectives. Thank you, guys. That is the end of our pre-submitted questions. So at this time, if you've been hanging out, listening in on mute, and you have a question, you've got something that's burning on your mind for John or Kathleen, now is your chance to come off mute and ask those questions. We'll give you a few seconds here. If you have anything you'd like to ask, you can also feel free to drop those questions in the chat. We'll do our best to answer as many as we can. Give it a little bit of time. I'm not seeing any yet. Folks are feeling quiet today. That's okay.
Perfect predictions from Kathleen.
It really was. It's a lot of information they're processing. Okay, I think we've given ourselves enough time there. If you do have questions that come up after the webinar, please don't hesitate to reach out anytime, and we are happy to connect you and help get those questions answered. Thank you so much all for joining us today. I want to give a special thanks again to Kathleen for sharing her time and her expert insights and perspectives on this topic with us. This is a great session that we love to have every year. And we hope to continue to do it in the future and have all of you join us again this time next year for the same topic. I also want to just make a note that you can sign up to receive email updates whenever we have a new WCMA webinar on the horizon. So make sure to log into your member compass. If you're a WCMA member, you already have access to that. Just go to our website and create an account, log right in, and you can choose to sign up to receive emails so that you won't miss any of our future informational member webinars. These are always free and we love to have you join us for them, so please do. Thank you again. We appreciate your time. We appreciate your attention. Hope you have a great afternoon and a wonderful winter holiday season. Thanks, everyone.